Well, more investors this year have taken cash positions than stock or mutual fund positions, according to a new survey. Joining me now is George Rusnak, co-head of Global Fixed Income Strategy at Wells Fargo Investment Institute, which authored the report along with Gallup. So, George, let's get right to the numbers. 43% of respondents moved money into cash this year. That's more than the 29% who took positions in stocks or mutual funds. So what's driving the hesitation here?
Yeah, it's a good question. So the survey came out, and actually there's conflicting information. The overall survey came out very strong from a confidence perspective. So we actually saw confidence tick up from 62 to 79, which is the highest that we've seen it since 2007. However, as you're pointing out, the underlying fundamentals, people seem concerned about volatility within the portfolio, risk within the portfolio, and so what we're seeing is actually a bigger movement towards cash within the portfolio, and specifically it's up to 19% specifically in direct cash investments and 11% in what we'd call quasi-cash investments, money market funds and CDs. So they're really taking a lot more conservative investment approach.
Well, that's sort of a double whammy for investors because they're taking cash positions, so they're not in the markets, but yet when they go in the markets, fixed income, they're getting, no return because interest rates are so low. So they're sort of getting it from both sides.
They are. The challenge there is that their expectations, which we think are realistic from a return perspective, roughly 7% is what most respondents said. We think that's a realistic goal for total return over a 10 to 15-year time horizon. However, you're not going to be able to achieve that if you have a third of your portfolio or 30% of your portfolio in cash. So that's the dichotomy there. It's challenging markets, but you need to have a long-term plan. Stick with it, stay invested in the markets, absolutely make tactical tilts, but not to the magnitude of 30%.
Well, when do you think investors will sort of come out of their, this cave and get back into the markets? Because 60% of investors in the survey are worried about how the election will impact markets. So do you think once the election is over and maybe once we get another rate hike from the Fed and that worry kind of subsides, we'll see people kind of come back into the markets? We
can only hope, and we're having those conversations with clients every day. I think the challenge there is that you can always find a reason to postpone your investing. And what we're trying to tell people is you need to have a long-term plan, stick with that long-term plan, and make some tilts along the way. It's not bad to have cash. It's bad to have a 30-year portfolio in cash.
Well, let's talk about some of those tilts because you work in the fixed income side.
Sure.
So what are you telling clients right now in terms of finding opportunities, knowing that we have the uncertainty surrounding the election, Brexit, and central bank policy?
And it's challenging with very low interest rates right now. So it is a challenging environment to invest in, especially for fixed income because of low interest rates. But again, it's important to diversify your fixed income portfolio. We'd strongly recommend right now investment-grade corporate bonds, roughly 1.4% above treasuries. In the financial sector, we think there's some good opportunities there. We also like diversification within TIPS, or Treasury inflation-protected securities. We think that inflation right now is extremely low, and even future inflation expectations are lower, so that it's a good bet right now to be going into things that are underappreciated, so to speak, within the marketplace.
All right, George Rusnak from Wells Fargo Investment Institute, thank you for sharing that survey with us.
Thanks for having me, Scott.
I'm Scott Gamm, and you're watching The Street.